So, are we getting a rate hike in June or just simply a pause? That's a question that some people have when it comes to the interest rates in the US. Now, we heard from a lot of FOMC members that came out after the last meeting about what they think when it comes to interest rates, whether they should continue hiking or whether there should be a pause. Now, before I get into those comments, my name is Daniel. I run an organization called Infovest that promotes financial literacy and teaches you about the macroeconomics and how it relates to all of these things here when it comes to stocks, bonds, commodities, currencies, and crypto as well. Now, let's get into this interesting article here. It comes out from Bloomberg. It says Fed officials reveal debate over whether to pause rate hike in June, creating more confusion, right? Are we getting rate hikes? Are we not? But didn't we hear from the last statement from the Federal Reserve that signaled basically a pause? That, hey, we're going to assess the situation and continue to be data dependent. Oh, wait, I forgot to mention that they did leave the door open for a hike. There were some Fed members that said, hey, just because, we might be thinking about pausing doesn't mean that we're done with hiking rates. We still can hike rates if inflation doesn't come down. We did hear previously from the Fed also say that, hey, inflation looks like it's going to be more stickier than we thought, and looks like we're going to have to continue to fight inflation for some time. It's going to be around that we're going to live with for some time. Now, what about the other members? Now, let me go through this article. I'll leave the link in the description so you could read up on it and follow along. But the first paragraph goes like this. It says, one of the Federal Reserve's more hawkish policy makers suggests it will need to keep raising interest rates, while four others stressed watching the impact for their tightening so far. So you do have some Federal Reserve members that are coming out and say, hey, I think we still need to hike rates. We still need to pump those numbers up in order to really bring the inflation down. And if we can do that, we can cause some sort of contraction, demand to come down, hard landing maybe, and we will see inflation come down. Now, investors bet that the Fed is going to hold for the next meeting in June. Now, when I look at the pricing in terms of what the market thinks about the next meeting, there's about a 17% chance, which is very low, that they're going to do a rate hike for the next meeting. But there's a high chance that, yes, they're going to pause, which is very likely, which I think is what's going to happen in June. I believe that they are going to pause and they're going to say things that, hey, we will be data dependent, we're going to assess the situation, and so on. Now, Williams, who is the vice chair of the policy setting FOMC, didn't spell out what he favored during the next month, but left an impression that he was comfortable with a wait-and-see approach. So the VP of the FOMC saying that, hey, I don't know what's going to be the situation, but it's better that we wait and see because there is some sort of lag. There's a lag when it comes to the policies. There's a lag in terms of the data. Yes, you're seeing the jobs data and this and that looking good. But again, remember, there's a lag to all of this. And that's why they want to sit and see, okay, after all this tightening that we've done, what is it going to look like when it comes to the data, the economy, credit conditions, and etc., etc. And don't forget, like Jerome Powell has told us, credit tightening in the credit conditions, tightening in the banking sector is almost equivalent to a rate hike, according to him. Now, a similar message was also conveyed by Logan, saying that when conditions are uncertain, you may need to travel more slowly. So another FOMC member coming out and say, hey, I think we should pause. I think we should see and monitor the situation. Let's not get out of hands. However, there is one or two or maybe a couple of them, but not many, but there are some FOMC members, like for example, Mester, who comes out more on the hawkish side, saying things like, we may have to do more. We may have to do more rate hikes. We may have to, hike more in order to tame the inflation dragon. Well, if, whether rates are going higher or they continue to stay higher for a longer period of time, history always tells us that something eventually probably breaks. And right now we're in May, next meeting is June. So in history, depending on which era you read and analyze, but they say that in history around pause tend to last around 6 months. So if I were to count this correctly, June, July, August, September, October, November, is it November we can start getting rate cuts? And what would be the reason to cut rates? Is it because something is going to break by November time of, this year? Or maybe not. The pause could even last longer than 6 months. And especially if inflation is sticky, like the Federal Reserve members are saying, and if data and the economy is showing strength, the job market showing strength and resilience, then why should they cut rates? You could see maybe they will come back and say, hey, we need to hike more, or stay on the course of the pause. Let's also not forget that the elections are coming up next year as well. So that's going to throw a lot of things haywire when it comes to the politics with the central bank versus the government. Now, it'll be interesting to see what they do in June. It'll be also very interesting to continue to monitor the data, the inflation numbers. Now, when you look at the CPI and inflation number, it comes in a little bit lower than 5%, around 4.9%, which is below the rates now. The rates are above the inflation, and this is what you need. You need interest rates to be above the inflation level and continue to stay there in order to tame the inflation dragon. And this goes back to the previous videos I was talking about. Just do a search on my channel and just say, look for, the Taylor rule. The Taylor rule basically specifies having rates above the inflation level. And in history, when you see that, and you keep rates above the inflation level for some time, that's when you get the inflation level to come down. That's when you basically slay the inflation dragon. Now, can this be a different situation where inflation tends to be stickier? They may have to go higher, maybe hike a little bit more. Possible. Could you argue that, hey, all the stimulus money that they pumped into the economy is still sitting there and we still have lots to wipe out? Maybe. But let's not forget credit conditions are tightening, so that if, you want to spur growth, an entrepreneur or a business person is going out there looking to get credit, it's going to be harder and harder, which should eventually slow down growth, slow down demand. And if there's a slowdown in demand and businesses are feeling the pinch, what does that lead to? That leads to possible layoffs, which then leads to people losing their job, which means that less spending, which means that you could get the inflation to come down as the Fed is expecting. The Fed is expecting for inflation to come down, and they expect that there would be some pain when it comes to the labor markets as well. And let's not forget another thing, that the small businesses make up, I believe, about 2/3. I'm not sure about this statistic. Maybe someone can verify in the comments. 2/3 or maybe more makes up about the hiring in the United States. About 2/3 small businesses, right? So you would think that a lot of people are employed by the big giant companies out there, the large companies out there, but actually they make up very small amount when it comes to the employment. It's the small businesses that are keeping people in their workforce and are doing most of the hiring. So if we are to see the labor market worsen off, then it will probably come from the weakness from these small businesses, which, again, if we get credit conditions to really contract, the small businesses are the first one to feel the pain. Just take a look at the Russell 2000 versus, S&P 500 or NASDAQ. You can see the Russell 2000, the small cap index indicator there. You're seeing pressure. You're seeing it having a tough time to rally the same way as, NASDAQ and S&P 500. You're not seeing that same strength. You're seeing weakness there. And it's possible that the Russell 2000 index could face more pain down the road, especially if these credit conditions worsen off, and especially in a hard landing. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.